All right, here we go. Episode 9 of The Rent Roll, your podcast on all things rental housing. I'm your host, Jay Parsons, and today we got a fun episode. We've been doing a lot of multifamily of late, but today it's going to be almost all about SFR. And I say almost, got a few exceptions, but today's a special episode talking about the Q3 earnings recaps for the SFR REITs and a very special conversation with today's guest, Dallas Tanner, the CEO of Invitation Homes. We're talking to him about the future of SFR, how it's evolved since really the creation of this sector just a couple of cycles ago, not that long. It's still a pretty young space, and it's already evolving pretty quickly from scattered site to acquisition, now to BTR. We'll be talking about whether that's a permanent shift or a temporary one resulting from today's environment. So stick with us. That's going to be a fun conversation with Dallas. Before we do that, though, we're getting into a little bit of a recap of the SFR earnings calls that just happened. 5 themes that I'll be sharing with you on takeaways from those calls. And we'll do our usual trivia, news coverage, and everything else and then we'll dive into our conversation with Dallas. So it's going to be a fun episode. Before we get into it, I want to give a big shout out to our sponsor, Madera Residential. As always, check them out at maderaresidential.com. All right, so we open every episode with a segment called Here's a Chart. And for those of you with video, this usually means that we can show you some charts and graphics that highlight trends going on in rental housing. Today, we're going to do a little differently. Instead of charts, we're going to give you highlights and recaps from the earnings calls from Invitation Homes and American Homes for Rent that just wrapped up just in the last couple of weeks. 5 key themes, takeaways to draw from the earnings calls. Again, talking about SFR this week. Next week, I'll be doing the same thing for the multifamily side. This week, all about SFR. So first thing, number 1, let's talk about looking at the impact of hurricanes and the response to the recent hurricanes across Florida and the Southeast. So both Invitation Homes and American Homes for Rent reported mostly minor damages, in part due to the fact that most of the institutional SFR product is more inland out of flood zones, but still some impact. Both Invitation Homes and American Homes for Rent said damage was mostly to roofs, fencing, and landscaping. Dallas Tanner of Invitation Homes, our guest later, he said, well, these moments can be challenging. They could also highlight some of the many benefits of leasing with us. Our mobile maintenance app allows our residents to log maintenance requests, attach pictures of storm damage, send those to us right away so we know what to expect before we even pull in the driveway. And then he goes on to talk about their large network of tree cutting crews, roofers, debris haulers, et cetera. And, his comments, and obviously this is true for others as well, it really highlights, I think, some of the advantages of the efficiencies of scale for some of these larger players able to respond to these challenges, not only faster with full-time resources, but also, because of the economies of scale, having quicker access to contractors who can solve for these issues. So that is a real advantage that some of these larger players have in the space. Another interesting quote, Brian Smith from American Homes for Rent, he said that hurricanes resulted in a temporary slowdown in leasing demand in Florida, but that's typical after storms, and he expects to see a bounce back or a rebound. And he said maybe not a dramatic one, but they're already seeing, quote unquote, a little bit of a pickup in Florida now. Another thing to look for is, at least I'll be curious about, is what impact, if any, we'll see to insurance premiums. Obviously, it's been a huge topic over these last few years for both SFR and multifamily. Got a little better this year as before all the storms hit, as we had some new players back into the market. But will this year's storms impact renewals for next year? We'll see. Now, obviously, the big companies, they can, to some degree, dilute some of the impact across the national portfolio, but it still could have some effect. But again, we don't know. It's hard to predict insurance markets. All right, second big theme and takeaway from SFR earnings call season, they're net sellers. So headlines are still plenty these days about institutional investors buying single-family homes, but in reality, they've gotten pretty quiet in the scattered site market of individual home buying off the MLS for quite a while now. This is not a new thing, and it continued through this year. American Homes for Rent did buy a sizable existing SFR portfolio of nearly 1,700 homes across 13 markets for $480 million. But in terms of one-off transactions, the REITs are, like I said, on the sidelines. And so are the other, the non-publicly traded institutional SFR owners for the most part as well. American Homes for Rent said they purchased only 16 homes in Q3 and they sold 256. They also plan to sell another 150 or so over the next 1 to 2 years. Much of are coming from that 1,700 home portfolio they just bought, with those 150 or so being outside their target buy box. Meanwhile, both AMH and Invitation said they're going to be continuing to focus a lot more on building new versus buying existing, which takes us to our third key theme, which is build, baby, build. All right, that's the rallying call of YIMBYs and developers. And it's increasingly true in institutional SFR as well. Both of the SFR REITs continue to prioritize new home construction of build-to-rent single-family homes over acquisition of older individual scattered site homes. Some of it is bulk inventory from home builders, and some of it gets more into the dedicated BTR communities as well, which are single-family homes and more of a multifamily style community. AMH said they delivered 753 new homes in Q3. For the year, they expect to be at 2,300 homes with yield in the upper fives. Plus, AMH said they have a pipeline of nearly 11,000 lots. Invitation Homes said they added nearly 900 newly built homes in Q3, and they're at 1,600 year to date with $560 million invested and cap rates around 6%. And in our interview today with Dallas Tanner, we'll be talking a lot about build to rent. And specifically, I want to get his take on whether this is a moment in time strategy resulting from low inventory and high prices, or a structural long-term shift in strategy for institutional SFR. So we'll come back to that. First, number 4, new supply is not just an apartment thing. I hear this one a lot. The supply is a headwind for multifamily, but not for single-family rentals. And certainly, I would say it's less of a headwind in SFR, but still a factor for sure in certain markets, especially in the Sun Belt, where we're seeing a lot of this new BTR construction. Not just BTR communities, by the way, which a lot of it gets tracked by some of the big data providers, but also thousands of newly built homes in traditional subdivisions too. And so that's impacting new lease rents for SFR REITs, keeping growth in the low single digits despite significant affordability advantage for renting versus buying, and also a lack of for sale inventory out there. So in fact, there was a really good question from one of the Wall Street analysts asking one of the REITs about why they're not seeing more pricing power given the dynamics of buying versus selling. The dynamics of buying versus renting. And this is part of it, which is that we're adding rental supply at a much better rate than we're doing this on the for sale side. So supply is doing what supply is supposed to do. AMH said there's pockets of near-term supply in certain markets. That's a quote. And they listed as one of the factors that right now is pushing them to, quote, plan to optimize revenue by prioritizing occupancy over the coming months. Also, they noted that most of the BTR is attached SFR, like townhomes, as opposed to detached SFR, and they're seeing more strength in detached right now, which is obviously more the focus of the SFR REIT, but clearly still having some impact. Invitation Homes said they saw, quote, some moderation in same-store revenue growth during the second half of the year, and said that among other factors, it's also being driven by some supply and absorption pressures, including from new BTR listings and motivated for lease pricing in a few of our markets, primarily Phoenix, Tampa, Orlando, and Dallas. So the good news for SFR REITs is just like on the multifamily side, supply is going to be coming back down. Invitation said that BTR deliveries could fall as much as 65% next year due to reduced starts over, really since last year and into this year. So supply could be becoming a tailwind again before too long. Again, very similar story in both multifamily and single-family rentals. And the fifth and final theme and takeaway from the SFR earnings calls, the Midwest is hot, thanks in part to low supply, just like in multifamily. So here's another parallel with the multifamily market, the strength of the Midwest, in part due to a lot less supply, plus some good, frankly, demand tailwinds as well. But also just, again, less supply in the Midwest relative to other parts of the country, especially the Sun Belt. Invitation said Chicago is one of their best markets right now with 10 to 11% new lease rent growth, well above what they're seeing in the higher supplied Sun Belt. Dallas Tanner directly credited the lack of supply in Chicago, noting in those areas of the country where there hasn't been much building in the last 3 or 4 years, that's going to lend itself to some near-term sort of rate help. So that's a quote from Dallas. And AMH is seeing a similar trend. Brian Smith said AMH is really pleased with the performance of our Midwestern markets. And then he credited AMH's product there as well as, quote, the lack of supply of similar assets, which is both new and existing, and expects continued good performance there in 2025. So So there you go. 5 key trends and highlights coming out of the earnings calls for the big 2 SFR REITs. We'll be talking a lot more with Dallas about diving into some of the trends and also the future trajectory of SFR in our conversation with him here in a bit. Next up, though, rental housing trivia. All right, so this week's rental housing trivia question is, in honor of our guest, what year was Invitation Homes started? We give you 4 choices. Was it 2009, 2010, 2011, or 2012? So you probably know it came out of the aftermath of the great financial crisis, but what year was it exactly? So give that some thought. We'll come back to that in a bit. First, though, in the news. So in the news, when we get to review some headlines from that are impacting rental housing and give you our quick take on them. So first one, this is actually wasn't so much a news headline. It was actually a paper written by a student at the NYU Stern School of Business. This was recently shared by one of his professors, which is how I saw it, and it's made a little bit of industry news. And the title of it is "The Impact of Institutional Investors on Homeownership and Neighborhood Access." So this is a good paper. If you've not seen it, I posted links to it both on X as well as LinkedIn. A few quick highlights I'll share. Number one, he noted in a summary, the institutional investors, number one, their presence resulted in lowered rents compared to what they would otherwise be due to the increase in rental supply. Now, this should be rather obvious. I'm not sure why people don't really see this, that more supply results in downward pressure on rents. But larger players also benefit from operational efficiencies of scale. So even with the downward pressure on rent growth, these can still be good investments due to downward pressure on expenses. So it can be a win-win. Number two, institutional investors lowered homeownership by, and I quote, less than expected. Now, of course, if an investor buys a home from an individual, that's one home out of the for sale market, but it's not just a one-for-one trade-off. And here the author writes, the impact is not one-to-one due to supply responses. Builders build and small landlords sell homes. Not accounting for supply leads to incorrectly estimating the impact by 4x. In other words, you can't simply assume every house bought by investors would have gone to an individual buyer. You can't ignore the impact to new supply resulting from investor purchases. And most importantly, you can't ignore a landlord exits from the market too, which most do. They sell. We talked about that earlier with some of the REITs. They sell too. And this is a big reason why homeownership has still trended upward nationally. And even in MSAs that we like to focus on, like Atlanta, even as institutional investors have bought homes. Now, another thing I would add, and this is my point, not the author's, I want to add to this as well, is that you really have to distinguish between the cycles. In the 2010s decade, especially the first half of that decade, we saw individuals that needed an exit, and institutional investors gave them an exit. They provided liquidity into a market where it was tough to sell. They gave an exit to homeowners who were underwater or bought up foreclosed homes that were otherwise sitting vacant that banks didn't know what to do with. And so, yeah, you did see movement in pricing, actually restoring home values and equity to homeowners because of their presence. Now, what we've seen since COVID, there's been other research by Freddie Mac and others showing institutional investors, they've not played as big of a role. And Freddie's research showed that they've really not had a meaningful impact on home prices. A lot of that was driven by the fact that we've been adding new homeowners faster than we've added for sale housing supply in recent years. So that's what have a bigger impact. So some of these things can ebb and flow a little bit, but the key point I want to draw from here is that, they've not been driving up home prices as much as people may think. And then the third thing I'll draw from this is that the author simulated a ban on investors as well as a 5% rent cap, as some have proposed. And he says that in his analysis, both policies raise rents because they decrease the rental supply, showing that mistaking the correlation between investors and rent increases for causation leads to counterproductive policy. That's a quote. So couldn't have said it better myself. Well-written paper. Give it a look. Again, posted on X and LinkedIn for those interested. Second headline. This comes from the National Association of Home Builders. It is their multifamily production index. It's a quarterly survey they do. And this provides yet another sign of a weak market for apartment developers and reduced supply ahead. Once again, it came in below 50 in Q3, meaning that most apartment builders still view conditions as poor, registered at 40 in Q3. It's up a tiny tick from Q3 of 23 when it was at 38, but still below where it was in Q2 of this year. And here's a quote from NAHB. It says, while demand for rental apartments remains strong enough to support relatively high occupancy rates in existing projects, multifamily builders and developers continue to face significant obstacles on new projects, such as higher construction costs, the cost and access to financing, and the availability of land and regulations. NAHB forecasts multifamily construction remain weak for another year as the market works through a substantial number of units under construction before moving back to long-term trends towards the end of 2025. And I think that probably makes sense in my view. But bear in mind, even if it's late 2025 before conditions are strong enough to support more starts, and then accounting for planning stages and financing and everything else, that's probably suggests below normal completions in 26 and 27 before completions start to really pick up. And even then, it's almost impossible to see you never want to say impossible. It's very difficult to see a scenario where supply could bounce back to 23 and 24 levels. The wording that NAHB used was more normal, which would, depending how you define that, more means like a reversion to the mean. So we were well above normal in supply. Certainly this year, we're going to be at record highs, 50-year highs. We're going to be probably below normal in 26 and 27. So, finding, kind of some midway point, probably looking more like we saw in the pre-COVID years, potentially by 2028. So we'll see. Next headline comes to the Wall Street Journal. America's empty apartments are finally starting to fill up. If that demand is sustained, landlords likely have more pricing power starting sometime next year. So here's an article from housing reporter Will Parker in the Wall Street Journal. A few takeaways from this. He writes, the vacancy rate stopped rising for the first time in 3 years last quarter as demand for apartments rose to its highest level since 2021, according to CoStar. If that demand is sustained and if the economy remains strong and housing prices remain near record highs, landlords will likely have more pricing power starting sometime next year. MAA CEO Eric Bolton was quoted saying, the worst of the pressures on pricing from new supply are likely behind us. And my personal view is, if those of you who followed this for a while, I think Eric's right. The data shows supply is peaking and should steadily decline over the next year before plunging in 2026. Also in the article, UDR's president Joe Fisher was quoted saying, probably the biggest story this year is what we've seen. Is from people coming in the front door and then not leaving out the back door. And I agree with Joe on that as well. So all this adds up to suggest that the consensus view on multifamily is already starting to play out. We're not past the hump yet by any means, but demand is strong, starts are way down, and barring an unexpected shift of some type, the supply-demand balance looks to be nearing a shift back in favor of investors after being strongly in favor of renters here this last 18 months and probably into 2025. And our last headline this week comes from the LAist, the Los Angeles media outlet. It says LA could cap rent hikes next year to 2% under new city rent control recommendations. So we talked about this last week. Prop 33 did fail, which means cities cannot expand rent control, but their rent control still does apply to certain properties across California. In Los Angeles, it's apartments built prior to 1978. And so what's really happening, it's really mom and pops who own rent-controlled properties in Los Angeles. These are not institutional grade multifamily buildings. But unfortunately, it looks like what's going to happen is a further squeeze on the mom and pops who own these rent-controlled apartments. The city commissioned a third-party report that suggests in a very polished academic terms that these mom and pops can afford to be further squeezed. And ironically, this comes out, just after California voters overwhelmingly shot down Prop 33 and kind of said, "Hey, this isn't working." But as it stands, LA, again, they can change the rules on properties that are already subject to rent control, at least for renewals, not for new leases. And again, rather than focus on expanding the city stock of affordable housing, the city appears to be discussing a lower cap on rent increases on renewals. So we'll see how it plays out. But the continued and ever evolving regulatory pressures on rent controlled or rent stabilized apartments in places like New York and Los Angeles seem to be, in my mind at least, making rent controlled apartments perhaps one of the most illiquid segments of the rental housing market. And I could be wrong, but it seems like a very tough investment case, which ultimately it's going to backfire on renters in the form of reduced capital to maintain and preserve these properties. All right, next segment is new digs. This is when we cover a really interesting and fun new apartment project or SFR, BTR project getting built. I haven't included this one in all of our podcasts, but in fact, I should have done this in the last one. We had our last guest in episode 8 was Paul Thrift, the CEO of Thompson Thrift. So today I want to highlight one of Thompson Thrift's projects. This is one that's leasing up just outside Pittsburgh in Moon Township, PA. It's called the Prism at Diamond Ridge. I like this one because we don't see much getting built in the Pittsburgh MSA these days, but it's a solid market, and I always like to see what does get built there. This one's 336 units, Class A, on the west side of town near the Pittsburgh airport. One very cool factoid, the Prism is connected via sidewalk to the Montour Trail, and that is the country's longest suburban rail trail, which is a multi-use, non-motorized recreational pathway that extends 47 miles. Yeah, so there you go. I thought that was a pretty cool factoid. And so that is our new digs project of the week in Pittsburgh, Pennsylvania. Next up, good question. All right, so good questions. We take a question that comes to us via social media or otherwise and try to address it for the broader audience here on the podcast. And so this was a comment I got related to single-family home prices and home ownership. And so the comment says, unfortunately, single-family home prices haven't seen the decline many were hoping for. Additionally, the traditional American dream of home ownership seems to be losing appeal for some. More people are opting to invest in experiences rather than in property. Add in the rising cost of home insurance with the challenges of insuring older homes, and owning a home is becoming an increasingly expensive commitment. All right, so I brought this up again. I agree with it to some extent, particularly when paired with increased quality of renting options. I feel like today's households just have more options. There's better quality renting, whether it's apartments or SFR, higher quality management, more conveniences, better locations and amenities, et cetera. But I do think the majority are still going to end up as home buyers, homeowners. They're just going to take longer to get there. I think we're going to see, though, number one, the American dream is still intact. We've seen, despite all the noise around it, homeownership has still gone up really since the mid-2010s. And now, of course, on the campaign trail and through the election with President-elect Trump, one of the things they've talked about is homeownership and preserving that American dream. So I think we're going to see a bipartisan effort to push through policies to help households buy homes and to help with starter home construction as well. I don't know exactly what it's going to look like, but I think we'll still see homeownership elevated in the U.S. But even absent higher mortgage rates, people are just taking longer to get married and have kids. And those are two lifestyle factors into purchasing homes. And we've just shifted toward each of these steps taking place later in life. So the median age of first-time homebuyers is now at 38 years old. So all of this just elongates the renting stage of life, which in turn provides a tailwind for rental housing. So I think rental housing could be very successful, even absent, and continue to be successful, by the way, it's been happening already, even absent a decline in homeownership. You don't need homeownership to come down in order for rental housing to perform well. Next up, the complaints department. All right, so this is a fun one where I get to, I get some cynical stuff over social media as well, and I don't always respond to it, but I do like to address some of it when it reflects a broader misunderstanding. So today, here's one. This is actually a comment from the NYU paper that I shared earlier on the podcast, and the comment came. It said, "Excellent article that totally misses the point. No social benefit is achieved by this activity," which is the activity he's referencing is single-family rentals. "So why should public policy or tax policy support it in any manner?" Well, first of all, I'd argue it really doesn't support it in much manner at all. In fact, we're generally pretty hostile, more than supportive of rental housing, especially in the single-family side. But call me crazy, but I think there's actually an enormous social benefit to ensuring that people who can't or don't want to buy a home still have access to safe, quality housing in good neighborhoods. I mean, single-family neighborhoods should not be exclusive to only those who have the means to buy a house. If that's a crazy opinion, I'm sorry, but I think that's a great way to ensure we have diversity and equity in our country, access to quality housing and quality neighborhoods. But sadly, comments like this reflect the type of ignorant, ill-informed view that reflects, thinking of a lot of folks today, including some in office. And we need to not be allergic to the facts. So, again, a reference that NYU study and others that provide good facts to counter some of this nonsense. All right, back to rental housing trivia. And again, this week's question was, in what year was Invitation Homes started? Was it 2009, 2010, 2011, or 2012? The answer, drum roll, 2012. In 2012, Blackstone purchased Treehouse Group and Riverstone Residential to create Invitation Homes. Then they went on a buying spree in April 2012 in Phoenix. Back then, Invitation Homes and others were widely regarded as rescue capital for underwater homeowners needing an exit and for families unable to buy a home, now needing a single-family home to live. Otherwise, I talked about this earlier, otherwise a lot of foreclosed homes just sat empty as banks didn't know what to do with them back then. And then in 2017, Invitation Homes went public with its IPO on the New York Stock Exchange. So I'm going to talk to Dallas Tanner a little bit now about the origin of Invitation Homes and his early days in it. And so we'll talk about a lot more about how that's evolved and where it's going in the future as well, with a shift into build to rent. So without further ado, let's move into the interview portion of today's podcast. And I welcome in Dallas Tanner. All right, welcome back. Now we're going to enter the interview portion of today's podcast, and I'm absolutely thrilled and honored to welcome in the CEO of Invitation Homes, Dallas Tanner. So Dallas, thanks so much for being here.
Hey, great to be with you. Thanks for having me.
All right, so you got into SFR, obviously. I mean, for those of you who don't know, Dallas, you got in very early in your career before it's really proven out as an institutional investment class. So I want to ask you, what did you see even prior to the Invitation Home days that others did not?
I think there's always an element of luck to this, right? With any sort of story that people would view as successful. But I think for us, we were so focused on housing in sort of its plural form that we had been, really active in the manufactured housing space starting in 2005, which led us to sort of dip our toe into the multifamily sector 06, 07, 08. And so at that point in Phoenix, we had a really good handle after 4 or 5 years of, buying and operating manufactured housing, buying and operating multifamily, that when the GFC happened, we were sort of blindly ambitious that we thought we could manage single family for rent. And we got a little bit of a lucky start in that we had a property that had a single family home. And I've told this story before, but we had a single family home that was on the fronting a major arterial road in Phoenix. And we put like $25,000 in this house, cleaned it up. It was a 3-bedroom, 2-bath. And we literally stuck a sign in front of the home that just said home for rent. And it was on one of our properties in the manufactured housing space. We had like 70 calls a day for this house. And, it looked nice. We had put the right time into it and given it some curb appeal. But that was like a big kind of aha moment for us in 2008, that there was just this inordinate amount of demand for single family housing. But a lot of the world was going through, obviously, a tipsy-turvy moment in terms of no one could qualify for a mortgage. A lot of people were losing homes or walking away from homes because the equity was so upside down. But the need state hadn't changed, right? And so I think that's what gave us the guts to start acquiring and buying homes. And there was years of supply on the market. Nobody was buying homes. And we were really, as an investor, we were really nervous about it because the bottom, for example, in Phoenix didn't happen until 2012. And so we're buying homes in 08 and 09 and not so much buying them thinking that we're going to have this unbelievable run up in value or anything like that. It was really more focused around, we knew there was an insane amount of demand for rent product. That drove the thesis. And so we bought about 1,000 homes in Phoenix over a 2-year period, buy, rehabilitate, lease to a family. Some of those people are still in our homes today, believe it or not. Pretty amazing. I got an email from somebody the other day that had been with us 11 years and just telling me how much she loved the product, which it just made me feel really happy. But anyway, that's how we got in. And then obviously institutional capital started to see a bottoming of pricing. And now you've got a few companies that have some real scale in the space, although it's pivoting, right? That was this moment where you could acquire because nobody was buying homes. And now you have to build it. And so we've definitely pivoted to building new product. That's the future for Invitation Homes.
Yeah, and I want to talk more about that in a little bit. But first, going back to the in history a little bit, you started off with that one house, you had all that demand. But was there ever you had a couple thousand homes? At what point you think we're really onto something here? This is really going to scale.
I think we started to have faith in our processes and our people and that we could operate at scale in those early years, like 2009 and 10. What really gave me confidence is when 20 different private equity groups were trying to give me money to manage on their behalf or to start to figure out how to build a real operating business. Because we knew that we'd sort of timed it okay with our own capital when we went in. But the reality is like there was this herd mentality trying to figure out how to invest in this sector and how to do it intelligently. And I think what was sort of interesting, I started to go from having a very singular view of a particular market like Phoenix. And then as I started to branch out and we started to think about allocating capital in Southern California and in Atlanta and then in parts of Florida, that was when I feel like even in my own journey, I started to have a much fuller view of not only like the opportunity set, but how bad things had gotten nationally. You just don't understand it until you live and breathe and touch it. And that was where I think we were like, okay, there's a really going to be a few years of this, of the market trying to sort of normalize. Could we build a really best in class company that could take the small piece of what we had done in Phoenix and could we amplify that across 10 or 13 major cities? And that's what gave me the conviction, I think, that we could do it because we'd done it in one market already. And so, just sort of finding those operators, finding the partners in the market that could perform, rehabs and management and kind of everything else. I think that was when I knew that we could do it, and it was a little bit of a race against the clock to try to do it effectively.
Yeah, and obviously it works. So you've seen this evolution, and I apologize in advance. I'm asking a longer question here because you've alluded to this in your first answer. Back in the early days, no one's buying these houses, so investors really looked at as rescuers for these homeowners who are underwater and needed a way out, or for foreclosed homes. And now, of course, we see investors often treated like the boogeyman. People need someone to blame for lack of for sale inventory, home appreciation, and rather than looking at the facts and seeing what's happened, we're institutional investors an easy target. We've seen legislation trying to penalize investors, most notably Senator Brown, who coincidentally just lost re-election in Ohio. And there's been a lot of effort, I know, and you've been part of it through NRHC and others, to educate policymakers on the facts, such as the low single-digit share of homes owned by large investors, but it just does not seem to stick. And so I know you've tried so hard, so this has got to be frustrating, right? I mean, and what else can be done to, really focus on real solutions?
Yeah, look, I think you have to sell it. You just said it really well. You have to separate the politics of housing from the fact patterns of housing. And sometimes that's not easy because the politics have a louder voice than the fact set. The second thing is you have to have a long view on this stuff. And I get obviously frustrated with the highs and the lows of sort of the public side of this. But I would just tell you, the market tends to get it right over time. And if you look at it, case in point, just coming off the last election, there was a lot of very favorable legislation passed in a number of states for people that want to bring more housing to the table and that want less regulation. And a lot of the deregulation efforts were successful in this last cycle. So it's extremely frustrating. I would argue that one of the things that nobody wants to talk about because they don't know how to solve it. And so you just pick the boogeyman, which you can call it private capital, Wall Street. They name it a ton of different things. The fact pattern is like, if you just look at the 16 million-ish single family homes that are for rent, it's like less than 4% are owned by what you would call a professional company, right? Somebody that has 24-hour service. We have 10,000 vendors in our database that can, attack an issue if a home has a problem. Like, that's what I would want when I'm renting. And in the world where I'm sure someday I'll rent something somewhere, I will rent from a company that has those type of services. Now, the flip side of that is that it's easy to say, well, there's, these companies are screwing things. It's just not true. You and I know it. Nobody's been buying homes on the MLS for the last 5 years. Like, that's not, everyone's building. Everyone's trying to build new product. So the real challenges are to some of the housing issues. It's not so much the politics. You'll deal with that. That'll come in fits and waves. And it was really amplified kind of post COVID, to be fair. And it was sort of an easy pinata to swing at, right? Like nobody could figure out housing solutions. There was this massive rush to the suburbs. Everyone wanted space. And so people were frustrated because home prices did this. And by the way, nobody's selling homes, right? And so it's just this really interesting conundrum, which will take a few years to work itself out. But the big issues are NIMBYism. So getting through local city councils, we deal with that in the projects that we're involved with. We're building homes. And the other issues are impact fees. I mean, it's pretty simple. Like a lot of people don't want development in their backyard. They don't want rental product, which is not really American at the end of the day. And then the second thing is cities and municipalities are charging an insane amount of money to start new housing starts. And so for a developer, whether you're selling a home, building a home for rent, building an apartment for rent, building condos for sale, it doesn't matter. Those impact fees are dramatic. We were just looking at a project in Colorado, and just to give you kind of perspective, $100,000 per home before we ever put a shovel in the ground to start. And that's just like unsustainable. So the pendulum swing, the markets will have to figure this stuff out, but that's the real challenge. It's not that there aren't, investors that want to build more housing and bring more supply to the table. It's really a challenge of like, NIMBYism, municipal impacts, and I would argue financing costs right now are a little bit high.
And I heard one the other day about this is existing single-family home where the permitting fees on renovation for fixing maintenance issues were 4 digits, and it's just like
Crazy.
you're just trying to take care of the property, right?
It's crazy. And look, there's certain things where you should have permitting, right? Like we get it. Like, if somebody's replacing a major electrical panel or something like that, that probably requires some form of permit. But I agree. It's like some of it's bonkers out there, and some municipalities are better than others. I mean, some markets, I won't name cities, but we have a couple of cities we operate where when somebody moves out of a home, you have to get the city inspector to come do a rental inspection. Think about what that does in terms of efficiencies. It's like, and that's not standard practice. So it's just, you have to figure out how to operate in some of these
Yeah,
new.
and then they have housing offline for people who need it. That's just crazy.
Crazy.
All right, so a lot of I think the misperceptions, in my personal views, I think a lot of anti-investor sentiment is really stems from either anti-renter sentiment or just misunderstanding renters. And so I want to ask you, the perception is a lot of these renters are just down their luck, want to be home buyers, but who is today's institutional SFR renter? Because I look at it and it looks like to me that it's, we have a lot of upper income renters by choice, at least for this stage in their lives.
Oh yeah, and we've been pretty vocal about our
Yep.
stats. Our customers now staying with us 4 to 5 years. They make, kind of usually typically a combined household income of in the 140, 150,000 range. Usually, a mom and dad or a partner situation, maybe a kid, one or two children. And they're looking for solutions around transportation corridors, decent access to schools. Funny enough, and we survey this every couple of years, different ways, but like in our latest round of thinking, about 2/3 of our customers could actually own a home if they wanted to. So, but about so if it's a third, maybe just have to rent. They need the space, but they can't afford to own. A third are like in a transition period. So, and it totally makes sense. Like I'm not saying anything groundbreaking here, but like I moved to Atlanta with two kids. I may check out the schools in Gwinnett County or in Alpharetta or in one of these areas before I decide to buy. And so if I can rent from a company like Invitation Homes, that may be a perfect solution for a couple of years while we figure out what we want to do, right? So that's that sort of middle bucket. And then the third bucket is preferential. We actually have a ton of people that are just like, nope, I just want to rent, or hey, I want to rent a second home in Florida that I'm going to rent and only be here 6 months a year. That's our kind of preferential bucket. We're seeing more boomers sort of come into play there. And so the demographics suggest to us, there's some stat that John Burns has out there that I really like. That's like, there's 13,000 people a day in their mid to late 30s turning that age every day right now. And that'll be that way for the next 10 years. So this is this sort of sweet spot with our customer being 38 years old, where they're trying to figure out whatever their long-term, plan for housing is. And I think back to your earlier question, it's just such a simple narrative to say everybody wants to own a home. Everybody should get a home. I have no issue with that. Like we have no issue with that. I'm a homeowner. We think 2/3 of the country want to own a home. But if you look at the last 40 or 50 years, just look at the data. Like about a third of the country leases something for some reason all the time. And I think we should be as professional and as sophisticated in meeting that demand as we can. It's a massive subset. The companies and the evolution of these companies should get better and better, just like Airbnb's gotten better, right? For travel, just like all these things. So for lease housing, in my view, should just get better and better. It should be more flexible. You should offer more services. You should be able to, have dynamic pricing with how you want to think about your lease, just like you would a car. And it should be easy and simple and convenient. So our goal is to keep making it more easy, a little bit more simple every year and more convenient.
Yeah, no, that's great. And so that kind of goes to my next question here. You kind of alluded to this a little bit, how things are changing so fast, but talk about what's changing in these preferences and behaviors among your customer, the SFR renters, and how's that impacted your property management strategy over the last 10, 12 years?
It's a really good question. So we've bundled a bunch of things as part of our experience set. So one is which is we've started to roll out like internet at a cost that's probably 15 to 20% cheaper. So you think about, our collective purchasing power as a company. We could go out and negotiate with a internet provider and say, we will pre-purchase or use our leverage to buy 5 or 10,000 accounts with that company, and then just pass that on to our customer. Everyone's going to have internet in their home, basically, in today's world. And so we find that really works well. The other is just smart technology, like a simple app that you can download. It's part of the process, part of what we provide in our rents, and it's part of our ancillary programs. But that you can have smart technology and adjust your thermostats while you're gone. Just simple stuff that a lot of us are doing as homeowners, but that aren't always available to somebody in a for lease environment. And so I think that meeting that dynamic matters. I also think, we're looking at things with like grocery companies right now. Are there just additional savings that do nothing for our company that we can pass on, that where we can create sort of a collective partnership with broad set of companies that are sort of a value add opportunity for our customers. So those are things we're looking at, trying to explore, figure out how to do better. You got to be careful not to screw up like your base business, which is just provide really great, responsible service, be quick to respond if there's an issue. But some of these other bells and whistles, I think, can be pretty enticing. And look, we just say, how do we lower the costs in some of these other categories? Because everyone's dealing with inflation, not just in housing costs, it's in everything. And so trying to find a way to be smart and sort of pass along those savings over time is, I think, creating a stickier experience for our customers. They want to stay longer and longer.
Yeah, that's a great point. Just thinking back these topics around who the customer is. It's interesting is, when I've seen surveys from John Burns and others, one of the things that really jumps out is these renters, the renter by choice group, people who could buy a house, just how much they want things taken care of for them, right? They don't want to deal with the maintenance. They don't want to deal with the stuff that comes up, the simplified internet for cheaper. Like all of these things seem to add up to maybe a lot of the people who have bad views of, professional management. They don't understand how much, the days of, your distant absentee landlord from 30 years ago, like that's not today's reality. And I'm not sure everybody understands that.
No, and then the other thing I have to tell myself is just remember, like, and this is simple math, like we have 110,000 homes on our platform today. If 1% of those homes, Jay, have like a major issue or something with the house, that's 1,100 times. So it's like 3 a day, right?
Yeah.
And so if 30 of those, make some internet chat board somewhere or media wants to focus on that, we'll never win that game. But what we win at is an 80%, almost 80% renewal statistic every year. It's unbelievable. Any business would kill for our renewal metrics. And then we measure ourselves. So every time a maintenance tech goes into a home, every time we survey on a scale of 1 to 5, and we're in the high 4s, like consistently in terms of our service levels as you kind of bundle those all up. So the key is just like using it as a marker to get better and better every day, to take the 1,100, hopefully down to 800 and down to 6, but we're playing in the law of large numbers. And so we're never going to be undefeated. We're dealing with a house. I feel the exact same way, for the record. And this is how I empathize with it. Like if something goes wrong in my house, I had 2 HVAC units go out in my house last year. I was losing my mind for a couple of days till those got fixed. Like that's just normal. So I always tell our people, like, guys, just put yourself in their shoes. It just is what it is. Things are going to break in homes and things go, south. It's just like if you have an issue with your car, nobody likes taking it to the dealership. Like it's just part of it. So let's do it fast, friendly, with, genuine care and a smile. And those customers will remember that. And over time that tends to win the day. But Absolutely. We're never going to be perfect.
Yeah, no, yeah. It's in baseball, you bat 300, be a Hall of Famer. In your business, you got about 1,000, or someone's upset. So.
Yeah, you're right. That's a good analogy. Like if you hit for 300, you get it right 30% of the time, but we get it right 98, 99.
Yeah.
And, it's the 1% that, as again, housing is, and it's the business we're in. Like, we expect it to be a little bit social, and
Yeah.
it's emotional. It just is what it is.
Yeah. So, one thing that's helping probably those maintenance issues is the build to rent. We're seeing more and more, obviously, invitation, others focusing, you've talked about this earlier and today, focusing on build to rent. And I think you sort of hinted at this, but let's talk more about, is this a moment in time strategy resulting from low inventory, high prices, high capital cost, or is this a structural long-term shift?
It's a really good question. It'll all be driven by the supply demand imbalances typically, right? So you and I, talked about this before. Like, we don't see like the world for companies like ours to grow to be buying homes as they sit on the market for a year or two. I don't think we're going to have that environment ever again, or for at least a long time. So I think if you want to meet the demand, you're going to have to figure out how to build the supply. And we've sort of decided a couple of years ago that we're going to pivot to our balance sheet, being really a strategic advantage for us. And, our company's pretty simple. We generate a couple $1 billion a year in rent. We pay all the expenses, including, a massive amount of property taxes every year, north of 400 million, I think now. And then we pay a dividend to our investors. And then we have about, anywhere from $300 to $400 million of free cash flow every year that we can keep investing in building new homes. And so we do that. And then if we issue stock or we issue new debt, we can use that incremental capital to go, and build more product. I think it's sort of similar to what we talked about earlier. Like, industries adjust, the smart ones do at least. And as we're starting to see this desire for flexible for lease product, and Jay, you follow this. So just think about how advantageous this is to a young family. If you're sitting there and you're like, I can move into a brand new home in a community where maybe we take care of the entire yard, the front yards, we'll keep the community looking excellent. You can move in for $2,500 a month, 1 month deposit, or you can buy that same home in the neighborhood next to it, and you need $60,000 or $70,000 down, and you maybe have a couple $1,000 mortgage payment plus HOA plus property tax plus insurance. And that's where right now, when you look at financing rates, because it's all subject to financing rates, it's about $1,100-$1,200 a month cheaper in today's market, if you look at our subset of homes, to rent than it is to buy. And I think that's a pretty amazing value proposition for a family. And if they decide they want to buy, terrific. We lose about anywhere from 18 to 25% of our move outs every year for the last 12 years have moved to home ownership. And we're actually trying to figure out ways that we could help support that. And we're looking at things like, could we partner with different mortgage affiliates? Could we do things that would help, speed up the process for people? But like, I think it's just where the puck is going, Jay, naturally. It's always been there. It was just a mom and pop sort of way of doing it before. And I think some people are really open to the idea of exploring how to sort of professionalize their for lease experience, which, by the way, we're just doing what the apartment industry's done really well for 30 or 40 years. Like, how do we professionalize it? And we're looking at things as a company right now. We'll have quite a few communities under our own umbrella by the end of next year. And we're actually looking at things from the apartment space to say, hey, how can we be a better community manager? Because it's a little bit different than our traditional, 90,000 homes scattered site business, which is a little bit more bespoke. It's more of a bespoke model where, we have maintenance vans that can come in and out of a neighborhood and identify issues and work on that one home. Whereas a community model, it can lend itself to some efficiencies and also some opportunities to make it a little bit more unique. So I would expect that evolution too, Jay. So I think it's where the puck is going. I think it's where smart capital wants to invest right now. We get calls all the time from outside investors saying, can we invest with you guys in your community models? They like it. And we weren't the originators of it. I got to, tip my hat to a lot of our peers who did this before we even did it, but we think we can be the best at it. And so using our scale infrastructure, figuring out how do we offer a service and an experience that people will like, we love this. Why would we ever want to do anything different? This is great. That's what we're going for.
Yeah, speaking of your peers, I mean, I don't know if it's our peer, but, back to the early days in Phoenix with like Next Metro starting that model with the communities. Yeah. By the way, one other thing I want to say real quick is I'm glad you mentioned even encouraging or finding ways to help renters buy houses. I think a lot of people outside the space don't understand. They see it as all like, hey, like if you're an investor, you want to keep people from buying houses. And I don't think the data even supports that. I mean, I think I'm a believer in the rising tide boosts all ships. If people are buying houses, there's going to be more renter demand behind that too.
100%. Like if we were 100% home ownership market, it would be an inefficient market, right?
Right.
And if we were a 70% leasing market, it wouldn't be a great market. We actually believe in sort of that balanced approach as part of our thesis in terms of how we think about capital allocation. We definitely want to see home ownership be part of the continuum. And look, if you just, I always say this, and I think it's fair. You look back over the last 40 or 50 years, the homeownership rate has been between 60 and 68%, 69%. And pre GFC, it got as high as 69 and 70 in some markets. It's probably too high. We probably had too many people being financed that weren't really in a position that wanted to should own a home. And then, you look at where it is today. I think it's in the mid 60s, 66, 67, depending on the market. That's a really healthy place to be if you just look at historical data. And I think you need people that are, locked into neighborhoods and not going to leave for a long time. And then you need people that create some of that flex that comes in and out. And it's good for values to have a really high homeownership rate too, because it makes, product sticky. And you look at why, the market drops like it did in 7 and 8 and 9 is because everyone was selling their homes at the same time. That's not a healthy situation either. It's not ideal. And so I think you just want balance. And you're right to point to data. If people just dig into the data, you would look at the housing market today and say, it's actually really healthy. We could use a little bit more supply. We probably need a little more sophistication around some of these leasing businesses. And we figure out a way to help. The other unsung part of kind of what's happened in the last 10 years, and you see it now, is smaller investors or smaller mom and pop operators of for rent product are totally using technologies and shared services and companies that we use now. And so that person that rents from a mom and pop is going to get a better experience over time as well. And that's what we should ultimately want. It should lift the rising tide of technology use. It should lift all boats. I totally agree.
Absolutely. One last question for you. Back to build to rent, man. You kind of alluded to the communities versus the guide sites. What do you see as the opportunity in buying excess inventory from builders versus, single BTR communities platted as multifamily? Are they different? I mean, how different are those opportunities?
We're big fans with our thesis around doing both. As you know, we built a really big scattered business early. And as we went into partnering, and our first kind of major partner was Pulte Homes. And Ryan Marshall and his team have been excellent partners. We've done a couple thousand doors, of which a big portion of that has been scattered inside their communities. They actually really like having us as a partner for a couple of reasons. One, we negotiate well in advance of what our terms are on those. Let's say they're building 300 homes and we're going to be 75 of those in that community. They can deliver our homes basically with the same fit and finish standards inside, right? Time and time again. They love that. It's simple for them. It also helps them underwrite their sales costs totally differently for a community because they know they're only going to have about 2/3 of the volume of what they need to think about. And so it allows them to be more efficient. For us, we love when our families are living next to homeowners because it makes the neighborhood a little bit stickier, to be honest. They like it because when they get families that come in and want a particular neighborhood, but maybe can't qualify for a mortgage right out of the gate, they'll actually send them to us and say, hey, you should talk to our partner Invitation because they're going to have 60 or 70 of these homes in here. And to jump on that, we also, and I want to make sure this is mentioned, we a couple of years ago started a company called Pathway Homes, which is a bridge to home ownership, where it's a rent to own model. And so as that company matures, we're going to continue to find evolutions where we can partner with some of our national home builder partners to place people hopefully in Pathway Homes. That's, we think, chapter 2, 3, and 4 of where that company can go. We haven't done any of it yet on a national basis, just in some pilot forms. But we see that being a natural solution to some of these gaps that happen for people. And that's the private sector solving some of that. The government's not going to solve those gaps in a way that's meaningful. I think we need smart capital to step in and sort of provide sort of some of these kind of stopgap measures so that people can fit where they need to be and also find ways to find flexibility.
Love that. Well, Dallas, thanks so much for your time today. Really appreciate it. I know the audience did too. So thank you.
Thanks, Jay. Appreciate your time.
And that's a wrap for episode 9 of the Rent Roll podcast. This week's episode is all about the SFR REITs. Next week's episode will be all about the multifamily REITs, recapping those performances. And we'll have a special guest joining us talking about the REIT world as well. So please join us for that. Until next time, big thanks again to Dallas. And thank you to all of you for spending part of your day with us. Enjoy the rest of your week, and we'll see you next time.